Hello, today I will be presenting to you another sample exercise for the advanced audit and assurance exam. In this case, the example audit client is called Queen Company, and we're going to start off with the draft financial statement, particularly the financial position. Here we will start off with non-current assets. So we have the comparison between 2 years, which is 2015 and 2014. So first off, what we can see is that the development expenditure for the last year has been zero, and now it's 60,000. In the exam, there could be zeros here, which means this is 60 million. However, this is not really that important. What's important is that you notice that there's definitely a 100% increase here. Then we see that the property, plant, and equipment has also increased significantly. This is an increase by at least, I would say at least 30%. The investments have been reduced. And then we move to current assets where the inventories have slightly reduced. The receivables have increased by about maybe 15 or 20%. Again, I'm roughly calculating here. And notice the cash, which is crucial. So a company is not a going concern. The cash has increased a lot from 62,000 or million, but let's just say it's thousand, to less than 10,000. So this decrease is sixfold, and this is massive. This is definitely going to be important later on when we're answering. The examining team will not put such big changes in amounts if it were not relevant. Okay. Payables, the amounts falling due within 1 year. Again, the payables have increased, so you have more receivables, more payables, and less cash. So the working capital is not good here. In 2015 for Queen's Company, now the total assets less the current liabilities have increased by a little. And again, the final payables have increased. So obviously here I'm highlighting the payables, receivables, the cash, and the other really relevant thing is the property, plant, and equipment. So the investments could be relevant. However, this is something that will be, you have to pay attention to what's further mentioned in the explanation. So what we're being told is that, let me just pick a highlighting tool. Queen Company produces wooden garden furniture and has incurred expenditure during the year on the development of moldings. So development, this is research and development. What's important to pay attention to there is that when you're talking about development costs should not be capitalized. Okay, research costs should be, however, there are criteria to meeting that. So development is a key word. When you see it in the AAA exam, make sure to highlight it because it's important. So the directors wish to carry forward the development expenditure indefinitely, as they feel that the company will benefit from the new moldings for many years. However, just because it's many years does not mean that it needs to be indefinitely. So definitely here we should highlight that there seems to be something that does not sound very rational. Okay, if it doesn't sound rational, then there could be there is a higher risk of misstatement. The product range is being developed because profits have been declining due to uncompetitiveness of the products made by the company. The company has sold many of its non-current assets during the year and purchased new machinery, which will enable the company's productivity to increase. The director decided not to fund the above expenditures using outside finance, but to generate the necessary resources internally. Okay, so highlighting it. Taking extended credit from suppliers and utilizing liquid funds. So basically what they're saying here is that instead of going to the bank and taking a loan, the directors of Queen have decided to basically simply pay their suppliers later, and potentially use more of its cash to fund the development, which is more convenient and quick. However, it could reduce, here there could be a question for business risk, and this would be a business risk. You could decrease the excuse me, the relationships with the suppliers. And if you decrease the relationship with the suppliers, it could mean business issues, losing suppliers, not getting enough production, then losing further customers. Not if you have less cash, it means less ability to pay, for example, things like rent, electricity, salaries. However, in this particular exam question, you are not asked business risks. So there is something here regarding business risks, but you're not going to be asked that, and you should not answer it because the answer is correct, but because you won't be answering the question that has been given, you will not get any points. Moving on, the company also sold part of its investments, which are made up of stocks and shares of public limited companies. So they're selling investments probably to raise cash. One of the reasons for this method of financing is that the company already has a loan. Okay, this is important, included in the figure of payables amount falling after more than 1 year. The loan is secured on non-current assets and is repayable over 10 years. Okay, highlighting this. The sale of non-current assets and investments did not yield as much as what expected, and a small loss of sale of 1,200 has been included in the statement representing comprehensive income as part of the amount shown for other expenses. The company had the non-current assets revalued by a professional valuer. So when there's a professional valuer, you have to ask the question, is that professional valuer within the company or outside? Are they qualified? Do they have a track record? Do they have documentation supporting their valuation or not? So professional valuer is something that occurs in the AAA exam every now and then, so pay attention if you see it. The gain on revaluation for non-current assets has been credited by the company to the revaluation surplus. So here you have to know the standard regarding what you're supposed to do with revaluations. The directors felt that the shareholders should share in the gain on the revaluation of the non-current assets and increase the proposed dividend accordingly. So they're increasing the dividend, which means higher costs, and over 90% of the shares of the company are held by the directors. So this means that the directors do have motivation to overstate the financial position of a company. For example, if it was a public company that um, for example, is on a stock exchange or wants to raise in external finance, then one of the risks of audit risks, this is not a question for audit risks, I'm just mentioning it here, is that the directors would be very motivated to overstate the financial position, the profits, the receivables, the cash, everything, the quick ratios, the KPIs, in order to raise finance and in order to impress the investors and stakeholders, because this would increase the value of the shares and therefore make them richer. So what is required? So we have four sub requirements here. So in total of 25 marks. So we have to describe the audit procedures which should be carried out to verify the value attributed to the development expenditure. Describe the audit procedures to be carried out to verify the gain arising on the revaluation of non-current assets. And C, explain to the directors why development expenditure should not be carried forward indefinitely in the financial statements. Again, this is theoretical. Here you get 8 marks regarding if you have rote learned knowledge, but most of the questions in the AAA exam will not give you any points for rote learning. You have to apply your knowledge. You have to explain how it matches the situation in the particular scenario. So 8 marks for rote learning here is actually a lot, but you may not necessarily get so much in the real exam. And finally, describe the implications for the company and the auditors of the director's decision to generate internally the funds. So Um, Beginning with the first part, the relevant audit procedures are. So you could write more or less procedures and also get full marks. However, what's extremely important in the exam is that you structure the answer like this, because the marker will find it much easier to read your answer and give you points. If you make their life easier, they will give you points. If you don't make their life easier and they're not in the mood, they'll give it will be less likely to receive 1 or 2 or even half a mark. And sometimes that half a mark or 1 mark is the difference between pass or fail. The auditors should obtain from the client a breakdown of the figure of development expenditure, which makes it possible to trace the amount spent to the nominal ledger and the final accounts. What this means is basically we're comparing the expenditure invoices to what was actually accounted for accuracy. So it wasn't mentioned here, but you could write that it's done for accuracy. So when you're writing audit procedures, always write why you're doing them. So in this case, you're doing it for accuracy. Another reason could be existence, for example, an inventory count, or maybe there was a factory and that factory got burned down. So going there, confirming that it burned down, confirms that it actually happened and that the directors are not lying on the financial statements about it. Tests of control should be performed to ensure that the system exists for controlling the authorizing and recording of development expenditure, and that the system is operating adequately. This work may be covered where practicable by the audit tests performed on the company's purchases and payroll system. 3. Individual amounts should be checked by reference to supporting documentation. The relevant documentation will vary according to the type of expenditure, but can be. Of course, you don't have to list all of these on the exam. You could just list one and you still get the full marks on this third point. First, you agree purchases to requisitions, orders, good received notes, invoices, and cash books. Agree the labor cost to the payroll, because when it comes to development, there are people working on the development, therefore they are on a payroll, and their payroll should be supporting evidence regarding the development. So labor costs regarding the development should be agreed. For example, with job cards, timesheets, salary that was paid, for example, in the in the bank statement. Another piece of evidence supporting documentation is if overheads have been included in the development figure. So this is if. Usually in the exam, examiners don't like if. So personally, I won't write this, but in this case, it has been given, and it's actually something that you will get 1 mark for. If overheads have been included in the development figure, ensure that they have been calculated on a basis consistent with that used generally by the company. So basically, this is the same with, for example, when a company has depreciation. When they're depreciating one, for example, machine, they should be depreciating with the same accounting policy the other machines in the same asset class. So this is something similar. If overheads were included, then they should have been calculated and accounted on the same basis with what is generally used by the company. So here you don't have to cite any particular accounting standards. If the auditors will wish to set a materiality level for testing individual items, this will have to be established when the breakdown of the total figure is known. For instance, it may be possible to restrict testing considerably if 1 or 2 large invoices represent the bulk of the relevant expenditure. Here, I've underlined something that a lot of students mistake, and it's a very common issue. It would be quite irrelevant to comment on who must prepare the materiality, what the percentage ought to be for net profit or total assets or revenue. Many students here will just write what they know, although nobody asked anything regarding who is supposed to set the materiality or how the audit is supposed to be planned. So materiality should be mentioned. Materiality should be mentioned here, that should be set, and based on it, invoices should be checked. However, the rest of the knowledge is, which I wrote in yellow, if you write it, it is correct it by itself. However, in this context, in this question, you will get 0 points. The arithmetical accuracy of the schedule or expenditure should be confirmed. The auditor should ensure the capitalized development items have also not been charged as an expense in the statement of profit and loss. So developmental costs, to correct myself earlier, they can be capitalized. However, they should not be at the same time expensed in the statement of profit or loss. Finally, the auditor should carry out a review of the development figure in order to be satisfied that it is reasonable and consistent with what else is known by the company in its business. Basically, the idea here is that the development cost should not be something that is obscene. For example, if a company has total assets of 10 million and the development costs are like 4 or 5 million, half of the assets, it seems suspiciously big. So again, the auditor should carry out the development figure and compare it with perhaps development figures from the past or development figures that are connected to the market or this particular, I guess, industry. So it seems reasonable. So moving on to section B, the following audit procedures may be performed to verify the revaluation gain. So this is much easier. This is regarding the revaluation expert that I highlighted earlier. First and obvious, ensure the valuer appears to be appropriately qualified and independent from the company. So if it's someone internal, then it's likely for there to be manipulation and prejudice regarding, especially from the directors who are shareholders of the company, to overvalue the assets and boost the financial statements. If these conditions are not fulfilled, the auditor should need to consider the possible impact on the results of the evaluation, ensure that the evaluation has been performed on a basis reasonable and consistent with previous valuation. So when it comes to calculations, policies, revaluations, always one of the procedures that you can always write and get a point on is regarding comparison with previous or historical revaluations, policies, and what basically has been done in the past by the same company. Ensure that the profits or losses on non-current assets have been correctly calculated by reference to the non-current assets register. Confirm the arithmetical accuracy of the revaluation schedule, the calculation of asset profit and losses. Basically, the revaluation should match what was written in the revaluation surplus or what was written in the income statement. And what I would personally add as a fifth here is something that, again, I've seen it in previous exams and it was included by the examiners as an answer, and that is to seek a third-party valuer or an independent valuer to reperform the same revaluation. And this is also called an auditor's expert. And this will confirm whether the valuation was actually reasonable. Part C, a little bit longer. Again, here we have cited accounting standards. You do not have to cite accounting standards in the exam, and you will get 0 points for rote learning the names of the accounting standards. You don't need to learn them. This is something that the examiners know that students have a difficulty with, so it's pointless to study it. Even professionals might not know the particular codes. What matters is what you're going to do in practice and how you're going to apply it. So what it says here is the development costs may be carried forward only if and to the extent that they represent an asset which will generate future economic benefits. It would contravene the reliability of concept to carry forward expenditure which is not reasonably expected to generate future revenue. According to the same standards, development expenditure should be recognized in profit or loss unless it meets the following criteria. So basically, it should be checked by the entity. If, again, in the upper procedures, we already went through that, the entity has to be able to prove that if it wants to capitalize the development costs, that there is technical feasibility of completing the intangible assets. So if there's no ability to complete it, if one of the engineers or scientists says that it is unlikely for it to be completed in the near future, then sorry, but this cannot be capitalized. It will go to profit and loss. The entity can demonstrate its intention to complete it. The entity can demonstrate its ability to use the asset and can show how the asset will generate probable future economic benefits. The availability of adequate technical, financial, and other resources to complete the development and to use or sell the asset can be shown. So basically, this is all connected to whether it can be completed, used, sold, if it's marketable, if there's a market for it. If there's no market for what's being developed, it will go to profit and loss. The market and marketability, or using it in your own production, in this case for plastics, in the case of Queen Company, is crucial. If you can't use it or sell it, profit and loss. The entity can reliably measure the expenditure attributed to the asset during its development. If, taking a prudent view of the available evidence, these conditions are met, development costs may be deferred and amortized over the period expected to benefit. So it is not allowed by accounting standards for development costs to be deferred indefinitely. So this has to be explained to the directors, and if there was a material mistake here, then they would need to be asked to correct it, because if they do not correct it, if there was a question here regarding the impact on the auditor report, then the auditor report would be qualified because there is a material misstatement. D. The decision to finance development internally has resulted in a large increase in payables. Again, you get easy marks for calculations. In this case, the 35% increase was calculated. If you go back here, the payables amount falling within 1 year. So from 170 to 231, that's a 35% increase. And if you go back here, the other easy mark, these two will give you probably 2 marks, and decreasing cash and cash balances. So this was calculated again here in the current assets. Cash is a current asset right here. So this will lead to liquidity problems, especially since the company will still need funds to finance the new product. So because it's an ongoing development, they will need finance to continue producing it. These funds will have to be generated either by the sale of further investments, which does not sound good, the raising of a loan from the directors or an outside investors. If funding is not available, the development expenditure should be recognized in profit and loss on the basis that it will not be possible to complete the project. They would eliminate the retained earnings reserve and would create doubts about the company status as a going concern. So basically, the cash will be less, the loans will be hard to pay, the development will be reduced. The company is already losing, market. So these reasons would raise going concern questions. And basically, in the exam, if you write that there's a going concern question, in on itself will not give you points. But if you say why it is a going concern, and you give, for example, 2 arguments, even if they're not the best, most hard arguments, if you just show the examiner that you're thinking and analyzing and thinking like an auditor, they will give you 2 points for this explanation. And finally, the auditor should discuss with the directors their plans for obtaining additional finance and request that they produce cash flow forecasts in support of these. This is because the cash flow forecasts prove the ability of the company to pay back the potential loan that they will receive. If the auditors do not obtain satisfactory evidence of the company's ability to obtain finance, it may be necessary to qualify the auditor's opinion on the grounds of going concern problems which have not been disclosed by Queen Company. So this is generally the question. If you have any questions regarding the answer, regarding the case, regarding anything I said, please write them in the comment section. I do offer tutoring, so if you have interest, if you want to ask more about it, how my approach is, I do my best. Then please ask in the comment section. And if you want us, to create a video regarding a particular problem, for example, audit reports or audit risks or business risks, then feel free again to comment. Thank you for watching.